world's oldest and largest futures exchange.
So Jim, thank you to be here. It's really a pleasure for us in Chinooky. And I just want to ask you some brief question about who you are, maybe for the Italian audience. Not so many people knows you, and it's a shame for me. And I just want to bring you here just to briefly explain, first of all, why did you start trading? Why did you start trading? A brief explanation of your story. It's a 15 years long story, I know. but where did you start?
I started out as a stockbroker for Merrill Lynch, a brokerage firm in the U.S. And it really wasn't to my liking. Then I got to Chicago and I started running an institutional trading desk. And from there I bought, or not bought, but I was provided an opportunity to have an exchange seat on the Chicago Board Options Exchange as it was starting. And additionally, I had a seat for the Chicago Board of Trade. So that was my real entree into trading. Prior to that, I had traded for myself and for clients, but I really didn't know much about trading. It wasn't until I got down onto the two floors that I got an understanding of one segment of trading. And that was a very narrow type of interest. Then as I expanded over the years, I got interested in particularly day trading. Okay. And that's really what I enjoy more than anything. Okay.
And now you are teaching or sharing your experience to all students all around the world. But what you are teaching right now, in which part of your career you started knowing markets as you do today?
I went for many, many years without really being profitable, other than being on the floor, from trading off the floor. And part of the issue was I never had a mentor. I had people that gave me information, but as it turned out, that really wasn't good information. In approximately, I think it was 1973, I don't know if I remember the year exactly, I was introduced to J. Peter Stottlemyre, who was a graduate in statistics from Stanford University. And he had conceived the idea that you could form a distribution curve if you had a constant as well as a variable. And the breakthrough was he determined that time could be the constant on the horizontal axis. So if you had the time on the horizontal axis and price on the vertical axis, you had a distribution curve. And a distribution curve is what scientists have used for years in order to organize and study data. That was a major breakthrough because for the first time I was looking at data that was objectively organized. And then it grew from there over many, many years.
Okay, really nice. I take one of your sentence. You just said that when you run an institutional desk, or where you are such a professional for us, which we are retail traders, you were not profitable?
No, the desk was profitable. I'm talking about my own personal trading.
Yeah. Which is the difference between the desk and yourself?
And myself. And part of it was lack of market understanding. Part of it was a lack of self-understanding. And now we spend a considerable amount of time focusing equally on market understanding and self-understanding.
Okay, but running an institutional desk, it's not making discretionary trading. It's like making other stuff.
Running an institutional desk is a combination because you're filling large orders for clients.
Okay.
But sometimes you are hedging those orders. If they can't be filled immediately, you may take the other side and actually hedge that order. So in a way, you are trading in a very small sense.
This is really interesting because here in Italy, a lot of people talks about how institutional trading is and how it works. how institutional run their desk, how institutional trades market. But you just said that if you have a big order from one of your clients, you are not executing it immediately, because it's not that, you know, it's not that good for the client itself and for you as a desk, isn't it?
Well, it's a very sophisticated operation. You may have an order for millions of shares. You may work that order over a week. You may work that order over months.
Over a month?
Many months in some cases. As the business got more sophisticated, there were many different ways in which institutional business was done. There were cases where the institutional brokerage firm would take the entire position off of the hands. They would take it, of course, at a discount, but then they would hedge it and then they would work that trade. So it became very, very sophisticated over the years, and there's no simple one explanation of how institutional business is conducted.
Okay. So a direct question: could we, retail traders, see when an institutional enter the market?
Absolutely not.
Okay.
The institutions go to great extremes so that you don't know what they're doing. If it was obvious what they were doing, shorter-term traders would run in front of them and they would get very bad fills. There's dark pools, which not really explainable in a short interview, but there's so many different ways that the business can be done. But institutions go to great extent that you don't know what they're doing, with one exception. If you do know what they're doing, you don't want to know, because they're showing you their order for a purpose. And if they're doing that, you don't want to know.
Okay, so it's so many times I saw a lot of video talking about order flow, for example, when they say that order flows, it's like you can see which kind of orders enter the market, and you can maybe understand when an institution or when a big trader or when a big, you know, when big money are taking the market. And for me, it's like, obviously after following you, it's like, it's not that edge. It's impossible having an edge on markets thinking like that. So is it true?
I think an individual trader trying to analyze order flow is a very, very poor idea. So as I say, if somebody wants you to know what they're doing, you don't want to know. Okay. They're trying to pull you into it, so you don't want to know that. But people teach that, they make it think it's going to give you an edge, and it does just the opposite, in my opinion.
Okay. Talking about...
And incidentally, there's people that greatly disagree with me on that.
Absolutely. That's why I'm asking you.
Yeah, a lot of people disagree because people have built their business teaching that. It's just from my point of view. We had a broker many years ago that nobody had any idea he executed business. They thought he was just a broker for himself on the floor. One of the very large hedge funds, one of the largest hedge funds in the world, paid him $5 million in commission one year in order to execute their business.
And no one
had any idea that this individual was executing for this large hedge fund.
How many years ago? What it happened?
50.
50? And
think what has happened in the meantime. They've gotten far more sophisticated in the meantime.
Okay.
And the hedging is so sophisticated that I couldn't even begin to understand all the hedging that goes on these days.
So for us, which is the best way to shift our focus? Where we have to focus on markets?
Well, my world is very narrow. I'm a short-term, day time frame trader. I may hold trades for maybe 2 or 3 days. But basically, I look at market-generated information. I look at the information that is coming into the market at any one point in time. And we're looking at 3 components: time, price, and volume. Most people trade price. Price is simply an advertising mechanism. How would you say, what do? I trade advertising mechanisms. Time regulates all opportunities, and volume measures the success or failure. So we do look at futures volume, and we do look at New York Stock Exchange volume just to get some estimate. Are higher prices, for example, bringing in more volume or less volume? Are lower prices bringing in more or less volume? There's nothing exact to it, but it is the best indication we have of what is going on in the market. And instead of focusing on price, we focus on value. And we use what is called the market profile, which is nothing more than a distribution curve. And that distribution curve, one standard deviation of the curve, of any curve, is approximately 67, 68%. So what we're trying to do is look around the edges, put the edges aside, and see where is the real activity taking place. And it's the activity that takes place within that one standard deviation, or approximately 70% of the market. And we look to see, is that migrating higher or lower throughout the day? Now that's an oversimplified explanation of what we do, but that is behind what we do. It's just looking at the data organized under a distribution curve, the same way scientists have looked at information for years. There's a lot of nuances involved in it, a lot of emotion for what the traders do, and of course, there's the straightforward information, but there's also the self-understanding, because the majority of mistakes we make as traders really are personal because of how we mentally process or fail to process information.
85–90% of retail traders coming from technical analysis, okay, which is quite easy to understand because it's, it's something you can see, something you can replicate. It's, that pattern, and you can, replicate the same decision every time you see that pattern. When they start studying something that you teach, it's quite difficult, it's quite different.
Technical analysis is basically centered on price. And as I said earlier, price is an advertising mechanism. Heraclitus in Greece said years ago, there's no real understanding unless there is context involved. When we look at the market through time, price, and volume, we are looking contextually at the market. So is price a consideration? Yes. But at the same time, we're putting context around that price. For example, if you had a business and you raised your price in the business and your volume decreased, you would lose market share. You would immediately know that that was not a good decision. If you raised the price of your business and you did the same amount of business, you would say that was a good decision. And it wouldn't be very long before you would try to do it again. If you look at the market the same way any businessman would look at a market, you will have a much better chance. But most people don't. They're too emotional. They're looking only at price, which I say is just an advertising mechanism. Trading is a business. Think of it as a business, approach it as a business. You have profit, you have loss, you have cash flow, you have taxes. All of those are the same considerations you have in business. You have those same considerations in trading. If you own a business and you make poor emotional decisions, you're going to have poor results for your business.
How trading changes during those 15 years career for you?
Actually, the change is not as dramatic as most people believe. Traders have, back in biblical times, there's been trading. The entire world, there's trading. And when you talk about trading, people are trying to buy low and sell high, or sell high and buy low. Many years ago, the trading in the US markets was centered around trading floors. And on trading floors, you had local traders that had an advantage. As they traded on the floor, they knew when the order flow came into the floor, if the volume was rising, that meant that higher prices were bringing in more activity. If prices were rising and the volume level was dropping off, their ears told them that higher prices were cutting off the activity. That was a tremendous advantage. And when I had a discount futures brokerage firm in Chicago, people always wanted to know what were the local traders on the floor doing. When the markets gave up trading floors and we went to electronic or screen-based trading, a tremendous opportunity was transferred to the individual trader. And that transfer of information, I think, has opened up trading to many people in the world that would not have been exposed to it before. The basics of trading haven't changed. Trading is a business. You know, you want to make money, you've got profits, you've got losses, you've got taxes. So the basics of trading are the same. The mechanism has changed. Most people don't know how to read an electronic screen and understand the information that is there. The floor trader got sensory information through his ears. The screen-based trader gets sensory information into his brain through his eyes. But you have to know what to look for. But the principles of trading are the same. There's no change in the principles. Yes, is volume higher? Yes. Are there more participants? Do people know how to hedge more? Has it become more sophisticated? Yes. But some of the so-called sophisticated trading is not as well thought out as the public would like to think. So I think it's an opportunity for a lot of traders that didn't have that opportunity before to become traders. Now, it's not something to undertake lightly. The majority of people do not make money because they don't know how to handle the emotional side of trading. But the information is more readily available to anybody than it ever was before.
Okay, thank you, Jim. It's been a pleasure and a privilege having you here. Hoping to having you next year. Thank you.
Thank you for the opportunity.